15 to 20 minutes to speak on this rather um, large subject of the future of banks and bankers. And I suppose it leaves the sort of geographical jurisdiction in which we are looking at the issue quite open. But what I'll try and do is relatively restrict myself to the Indian case because we know across the world, despite the 2008 financial crisis, at the center of which was the speculative run of managers in a highly liberalized and unfettered banking system, which had gone through a long phase in which deregulation had increased the so-called flexibility of bank managers and shareholders in the banking system. That despite that experience and despite more than a decade since then and a large number of committees and commissions which were set up to try and look at the factors which were responsible, we are in some sense back to, besides the impact of crises like the COVID-induced crisis now, we are back to a situation in which the practice of banking has fundamentally not altered in any major way. In fact, banks got back to profit much earlier than others who were affected by the crisis, even though they were not responsible for it. And we know that bank managers and managers and those who are managing assets in the non-bank financial institutions once again got back to earning large bonuses and profits, so that really it was business as usual. But I want to look at this kind of a tendency in from the point of view of the Indian case in the short time I have, essentially because when we ask ourselves the question, what is the future of banking? And of course, the future of banking is going to determine the future of bankers, whether they're going to be agents who would contribute to the developmental agenda or become cogs, in a structure which actually subjects the banking system or makes the banking system a conduit for mobilizing public savings and allocating it for speculative purposes. And that, of course, obviously increases the risks of the jobs they have, the pressure of the kind of jobs that they undertake, the remuneration that they can get, the inequalities which would come within the banking system, etc. So it's best we look at the nature of banking per se, because that has implications for what happens to bankers. And here again, as we know, that there is one possible future which we can think of, and that's a future in which things continue as they have been evolving in over the last couple of decades or more. And that, of course, is one in which we know that after a period of time, when it appeared that there was some kind of an effort to try and restructure the banking system, we entered a phase in which banks became the instrumentality for a neoliberal development agenda, which essentially meant using the state, using the public banking system in order to push its idea that while investment must largely be driven by private incentive and private profit, with the state playing the role of facilitator, in that role of facilitation, the state should try and create the basis for what was seen as the possibility of a rapid rate of growth. And central to that sort of base which was going to be created was the state intervening in order to create a large infrastructural base which would facilitate trade, which would facilitate, which would generate demands for private products. And we entered the era in which, just as happened across the globe, we began to talk about these mega projects, mega infrastructural projects, which the private sector on its own, on the basis of its own capital, could not fund. And so the whole idea was that you try and use the public banking system as a conduit to mobilize public savings and allocate it in the direction of investments of this kind, so as to provide the infrastructure required by private operators, ostensibly to push growth in the industrial and non-industrial sectors. Now, one consequence of that we know is that in a relatively short period of time, out of something like 40 to 50% of total credit from the public banking system, or banking system as a whole, the scheduled commercial banking system as a whole, which goes to industry, we started with a situation in which 3% or less of that total amount allocated to industry from the credit which is provided by the banking system went to infrastructure. But by the time we got to 2012, 2014, and so on and so forth, that ratio stood at something like 35% or more. That is, public banks became, in a period in which there was a huge expansion of liquidity and therefore the volume of deposits and the credit provided by the banking system increasing, you saw a substantial increase in the allocation of credit by the public banking system in particular to the infrastructural sector, which is problematic because of the fact that since the banking system gets a significant amount of its capital from those who are looking at shorter maturities, who don't want either capital or interest rate risk, and who want a significant degree of liquidity. They want to go back to the bank and take their money as and when they need it for some purpose. If you take money of that kind, short-term funds which backed by expectations of liquidity, and use it for long-term capital-intensive investments in relatively illiquid projects like the infrastructural sector is, then obviously there are significant liquidity and maturity mismatches. And this, among other factors, but this I think in particular, resulted in a situation where we saw a substantial accumulation of non-performing assets in the banking system. The link between the accumulation of those non-performing assets and the overall neoliberal growth strategy was sought to be concealed or attention from it deflected. It was made to appear as if a few bankers, rogue bankers who were in cahoots with a set of rogue investors or business groups indulged in a set of activities which generated these non-performing assets. But really, these non-performing assets reflected the fact that you were using the banking system as an instrumentality, which was not something which the banking sector could serve unless the central bank, sitting at the apex, provides a guarantee that as and when banks are confronted with illiquidity, they would be provided with the necessary liquidity, and the state, also sitting at the apex, decides that it would actually recapitalize as and when necessary these banking systems because of the fact that they were playing the role of the instrument of the states and the central bank's overall neoliberal agenda. But then what we know is that that didn't happen in adequate measure. There was talk of recapitalization, that doesn't happen. And therefore we entered a situation in which the problem of non-performing assets did not go away. In fact, it remained quite serious and significant despite large write-offs, which affected the profitability of the banking system and its ability to extend further credit. And at that point of time, of course, we had the COVID pandemic, which has created a situation where it was necessary in order to keep in business or to just keep afloat, to allow to survive a range of businesses varying from micro and small and medium enterprises to medium and big business, that you needed to provide them with credit, because otherwise in this period of the complete, the total stop to economic activity which occurred, not just because of the pandemic, but because of the lockdown response to the pandemic, which was very significant and stringent in the Indian case, we found a situation where once again you began to use the banking system with some partial guarantees in the case of some of that credit, like the emergency credit guarantee scheme for the micro, small and medium enterprises. But to a substantial degree, you were pushing the banking system, already sitting on non-performing assets, to put out more credit just by backing it with liquidity infusion by the central bank. And that essentially means, as many senior bankers have declared, is going to be a situation in which a few months down the line, we are going to see a substantial degree of a substantial increase in the volume of non-performing assets. And as that occurs in a context in which the crisis is intensifying the fiscal crisis of a state, which was virtually handing over what was erstwhile tax revenues as concessions to the private sector, including the large direct tax concession which was provided in September 2019 to ostensibly address the demand recession which had come before the COVID crisis. You've ended up with a situation where the fiscal crisis, as far as the state is concerned, both central and states, has intensified hugely, and therefore the argument is going to be that there is no money really to recapitalize these banks, and therefore, where if you stick to this trajectory, are we going to go? And perhaps a signal has come just yesterday and today when the ICICI, of course a private bank, has gone to the market and managed to mobilize in the first round 15,000 crores, because we happen to be in a situation where the demand recession, which has affected the real sector, has released substantial volume of funds, backed also by the infusion of liquidity by central banks globally, including the Federal Reserve. This is large liquidity is in search of investment avenues. So if you actually take, established public businesses to market, or private businesses to market, as happened in the Reliance case, for example, Reliance Jio, for example, you're going to be in a position to be able to quite easily mobilize large volumes of capital despite the recession, despite the crisis. And therefore, the argument is going to be, we need to privatize these banks. And once you begin that process of privatizing banks, and if you want the kind of capital that you need to recapitalize banks through actually issue of new shares and new equity, you're going to have to go through a process in which you're going to allow to international investors as well to come and invest in the domestic banking system, domestic public banking system. And therefore, we are going to see a future which is going to be a future which is only going to aggravate a tendency where the potential for the use of the banking system, which is the first port of call of the nation's savings, we have used in the past the banking system as well as the insurance infrastructure, life insurance corporation, the GIC, etc. We've used the assets mobilized by these entities from the public at large to divert them in directions which generate or which stimulate growth, which stimulates that growth in a way in which you do not discriminate either vertically or horizontally. You don't give only 2% credit to agriculture, as was happening, let us say, in the mid-1960s before bank nationalization. You don't give no credit to small enterprises. You don't give no credit to small players, self-employed, and so on. You therefore you not only had the use of the banking system as an intermediary to push growth by financing crucial economic activities, but you also did it in a fashion which you thought was going to be more inclusive, which was what really the priority sector lending program was all about. And you wanted to do all of this, get your growth, get your inclusion, without actually rendering the financial system or the banking system unstable. That you did not want to have a situation where, like it happened with Palay Bank and Lakshmi Bank and so on and so forth, that you have bank failures, or which subsequently happened to the private banks, including more recently Yes Bank and so on. You didn't want to have that kind of fragility, and therefore you not merely sought ways of making the banking system an instrumentality, but you realized on the basis of long experience that the only way in which you can meet these goals of growth, inclusion, and stability was to actually have public ownership, in which you not merely have direct monitoring of the operation of the public banking system by Parliament and the people, but you also had, to a certain extent, an alignment of the objectives of the state and of bank managers, of banks in general, and the shareholder, after all, being the state itself, of the shareholders, the state as shareholder and the state as leader of the development agenda. Now, this, of course, is one scenario where you end up with a private banking system, to significant measure internationally owned, which enters into a realm where profit drives credit creation, and you really have a tendency towards loss of inclusion and stability, as we've observed across the world after long periods of financial liberalization. The other is a possibility where we actually go back and ask ourselves, what exactly did we try to do in the period starting from 1951, let us say, or even earlier, because the Banking Act came even earlier, 1948. We start from 1947. And what we know is that the understanding which prevailed then, and I think we can stick by that understanding, was that given the level of development of our economy, given its structure, it was necessary in some sense to have a segmented financial structure, that you can't expect banks to do everything, even though banks were the primary port of call of the nation's savings. You needed specialized financial institutions which delivered on particular fronts. So we set up a huge development finance architecture starting with the IFCI, the ICICI, leading up to the IDBI, and subsequently NABARD and so on. We created this development financing architecture with two purposes. First, it was clear that in order, you needed these kinds of institutions which were backed by the central bank, the budget, in order to be able to close the gap for long-term finance. That is, you really, if you want to finance long-term investments in capital-intensive areas, including infrastructure, you can't get the banking system to do that. You need these specialized financial institutions. And secondly, you needed these institutions to partly meet the investment requirements in socially crucial sectors, like in agriculture, like in small industries. So you set up a refinancing and lending entity like SIDBI. You created this whole infrastructure. So that was one segment. The second segment is that you realize that, listen, that while brick and mortar banking of large scale is over a period of time going to grow and expand and extend its reach, you needed also specialized institutions. So you had an emphasis on cooperative banks, which had a different kind of governance, more decentralized governance with the role for the state governments, which has gone now as they've been forced to go back to being only monitored and regulated by the central bank, like the commercial banks. So you're going to transform them into normal commercial banks. You also recognize the need to set up special rural financing institutions. So you got the banking system to set up the regional rural banks, which played an extremely crucial role in rural financing well after nationalization. So you actually created a segmented banking structure in which you had specific mandates of what they are intended to do, what kind of gaps they were supposed to fill. They had jurisdictional restrictions. They lent in particular jurisdictions. They were not primarily seen as driving for profit, but they were seen as realizing larger objectives, including the objectives of growth, inclusion, and stability. And therefore, you thought that having this segmented structure was the way to go. And I still think that is the way to go, even though we know that one of the sort of damages which financial liberalization inflicted was, of course, ostensibly creating a level playing field by getting rid of the development banking institutions. And therefore, we really had to force the public banks to become the primary funders of capital intensive projects and infrastructure, including in the private sector. And of course, you are beginning to see the loss of that kind of inclusion, horizontal and vertical inclusion. It still is there because banks are still public and are still playing a role, but we know that rural bank branches, because they're being relocated, etc., are shrinking, that you're trying to find correspondent banks, sort of digitally integrated small payments and banks of that kind run by the large corporations, which are actually trying to skim the profit of a large rural market and therefore are not really interested in inclusion, even though they are being promoted in the name of these kinds of banks are being promoted in the name of inclusion. But essentially what we're seeing is a withdrawal from that front. And so you have a loss of the ability to fund growth because of the huge accumulation of non-performing assets, and that's only going to intensify. We've been seeing the loss of a certain degree of role in ensuring inclusion. And we know that as far as the private banks are concerned, that despite having been hailed as the sort of models which public banks should follow post the liberalization, the so-called, not the old private banks, but the so-called new private banks, many of which, of course, have either closed down or been merged, like Times Bank, etc., and others like Yes Bank, etc., are in deep trouble. So you essentially have and we know Mr. Gelly, who was supposed to be this fantastic banker, created this bank, which essentially was presented as a model, but then had to be taken over by a public bank. That kind of fragility would soon begin to touch upon the public banking system, more so as when the difficulties it faces because of what public bank is being made to do by a government which actually has adopted a neoliberal agenda which it is imposing upon a public banking system. that we actually have a situation in which you're not going to see the recapitalization needed. You're not going to see the backing for the central bank and the state as the German banks at one point of time used to get is going to be given. So the route will be in the direction of privatization, and that would only aggravate this tendency to to sort of withdraw, to fail to deliver on something which we began, which the lessons which were learned in the period from 1947 to 1969 and began to be implemented after 1969 with amazing results, as we know, till 1991. And that instead of actually moving that forward, which should be the future of a segmented financial structure, and then you begin to undermine the rest of the financial structure. You begin to get an LIC to play the role which the central bank and the state should play in taking over weak banks. You get it to take over IDBI. You get it to put money into entities which are failing, and weakening even those kinds of institutions which have played an extremely important role from the point of view of funding the development agenda of the post-independent state, and for which is the reason why life insurance was nationalized and subsequently also general insurance, that we are going to see a spread of this disease. So that would be one kind. The other would be, as I said, to move the agenda forward, an agenda which was learned through practice when we inherited an extremely weak and fragile banking system from the British in 1947, which we reconstructed and then made extremely viable from a growth, stability, and inclusion point of view in the period between 1969 and 1991. We have now undermined that, and that is possibly creating a different kind of agenda, which has to be obviously fought against, which hopefully people would help reverse. And the bank employees would obviously have a major stake in actually doing that kind of thing, because it would be something which affects their own, not merely their career prospects, but the kind of banking citizens that they would be forced to be within a more speculative, short-termist structure, which would get constructed as a result of this kind of agenda. I think I've taken my 20 minutes or more, maybe, so I perhaps should stop now.